Rachel Reeves has just delivered the autumn budget, and once again, there are tax changes and tax rises. These tax changes will affect your take-home pay and the amount you retain in your pocket. Allowances have been affected and landlords have been hit badly. Once again, employers are being attacked. These rules are going to hit everyone, from employees to landlords to retirees to business owners. And so, stay around to the end to know your options to reduce or remove the effect. In this video, I'm breaking down what the autumn budget really means for your money, what the tax changes are, and the one thing you must do before it's too late. Hi, I'm Amma, a chartered accountant and a tax professional from AB & Co Accounting and Tax Services. The first change is they have once again frozen the income tax and national insurance thresholds for an additional 3 years, all the way up to 2030 to 2031. This may not sound very dramatic, but let me explain what it does to your money. Because of inflation, most people are going to be pushed into the higher tax bands. So you will begin to pay tax at the highest and the higher rate of taxes because of inflation. Imagine getting taxed at 40% and 45%. That is huge. That is aside paying national insurance. And this will be around for a very long time, up until 2030 to 2031. This is what is called physical drag. Allowances are frozen and they don't rise with inflation, and that affects almost all households. That is a big tax change. The next change is affecting your dividends, your savings interest, and your rental income. They are increasing the tax rate for these by 2%. So from 6th of April 2026, the dividend tax rates are increasing, and this is how they are increasing by 2%. Currently, dividend tax rates are: basic rate is 8.75%, and this will be moving to 10.75% from 6th of April 2026. The higher rate of tax is at 33.75, and it will be moving by 2% to 35.75. Additional rate will be moving from 39.35 to 41.35%. And all these changes are going to start from 6th of April 2026 for dividends. Now let's consider when and how your savings interest and your rental income tax rates are changing, and that will start from 6th of April 2027. Again, these are going up by 2%. Currently, both the savings and the rental income are taxed within the income tax thresholds, which are 20% for basic rate taxpayers, 40% for higher rate taxpayers, and 45% for additional rate taxpayers. For savings interest and your rental income from 6th of April 2027, they are going to be increased by 2%, which means if any savings interest or your rental profit falls within the basic rate band, you're going to be taxed at 22% instead of 20%. If any savings interest and or rental profit falls within the higher rate band, you're going to be taxed at 42%. And if any savings and or rental profit falls within the additional rate band, you're going to be taxed at 47%. These are the tax rises that are affecting your dividend, your savings, and your rental income. It looks like landlords are being attacked from not being able to claim the full amount of mortgage interest to increases in tax rate on your rental profit. It's an attack on your profit. What do you need to do now to reduce or eliminate the effect? If you own properties, it's time to consider if incorporating or transferring it into a limited company is the best option for you. It's time to speak to your accountant or us to assess if moving to a limited company is the best option for you. But please note, if you don't get incorporation relief, then there are taxes like capital gains tax and stamp duties when you transfer the property into a limited company. So it's better to speak to your accountant or us to consider all to see if the move will be the best option for you overall. Before we move on, for more tax strategies and tax reduction tips and education, please subscribe to our channel and also comment and share our videos so that we can reach more people who may also find this and our videos useful. The next change that is also going to affect landlords is what is called mansion tax. Starting from 2028, if you own any property worth over £2 million, you are going to pay an annual surcharge in addition to your council tax. If your property is worth over 2 million, you're going to pay an annual surcharge of 2,500 per year. That is not just once, per year. If your property is worth more than 5 million pounds, you are going to pay an annual surcharge of 7,500 in addition to your council tax. This is an attack to all property owners, not just people who are renting their properties, but also it affects you who have your main residence that you are living in. So it affects everyone in this category. Things to consider to reduce the effect or eliminate the effects: if your property has outbuildings or annex, consider splitting the title deeds and adding other owners to the property. This will reduce the value of each property under each owner, and that will make you stay away from this annual surcharge. The next one is salary sacrifice. From 2029, the government is putting a cap on the amount you can sacrifice from your gross salary into pension at £2,000 per tax year. The first £2,000 you sacrifice out of your salary into pension will not attract any national insurance, but any amount over the £2,000 cap will attract both the employee and the employer's national insurance. And so employers are getting attacked here once again. This has effect in your pocket because the amount that you get as your net pay is going to be reduced. Therefore, if you have ever wanted to boost your pension pot, this is the time. Until 2029, you still have time to boost your pension pot. So use the opportunity to boost the pension pot as much as you can. Another change that was introduced in the autumn budget is your cash ISA. From 2027, if you are 65 years old or under, then the amount that you can contribute into your cash ISA is £12,000. It's no more £20,000. If you are over 65 years, you can continue to contribute the full current ISA allowance of £20,000. Reduction in your cash ISA allowances means reduction in tax reliefs that the cash ISA offers. If you look at this carefully, if you don't put your cash into the cash ISA, then people will begin to put their money in other banks, earning them interest. And remember, the savings interest is taxed. And as previously said, tax rates for savings interest are going up. So the amount of tax relief that you get will be reduced from 2027. It's time to maximize your ISA allowance as much as you can before this deadline. Before we move on, for tax reduction tips, please consider subscribing to our channel. And don't forget to share this video to your other friends who may also find all our videos useful. Comment and share your thoughts about the autumn budget in the comment section. The next one is a major change affecting people living outside the UK. The autumn budget saw the abolition of the voluntary Class 2 national insurance contribution. This means if you're living outside the UK, you can no more make voluntary Class 2 national insurance contributions to help you benefit from state pension. Therefore, if you have any gaps, you need to fill these gaps before you leave the UK. And also consider meeting the minimum 10 years of national insurance contribution in the UK before you leave if you want to benefit from state pension. Before the autumn budget, there were so many speculations about VAT thresholds dropping to 30,000. The good news is the VAT threshold didn't move any inch. It still remains the 90,000. But with rising costs and rising prices, most businesses are going to be pushed into the 90,000 and meeting the VAT threshold for registering for VAT. This means higher prices, more admin, less profit for business owners. So even though the VAT threshold didn't move down to 30,000, the more businesses may be pushed to meeting this threshold because of rising costs and rising prices. So these are the tax changes, the tax rises, reduction in allowances for you. This is the real story behind the budget. If you have found this video useful, please share your thoughts about the budget in the comment section. And don't forget to hit the like button to signal us that you have actually enjoyed this video and have benefited from the video. Don't forget to subscribe to our channel and share the video to people who may also find this useful. And as always, all our videos are for education purposes only and should not be used in any way as a tax advice or any form of advice. For tailored advice, please contact your accountant or contact us. Thank you for watching.